18th tax, 18th tax season. What we've been doing a lot of real estate investing and real estate investor taxes, and I'm also a real estate investor. I've done everything from mixed use, multifamily, single family, and some failed flips. And so a lot of these things I've not only seen but experienced. So that's kind of how my practice has been run and my background experience. And so our first common mistake that we typically see when we are reviewing the prior year tax returns of a predecessor accountant is the failure to separate land and building costs. So a lot of times we'll be reviewing depreciation schedules, and we'll be looking, to make sure that everything's classified correctly, and we'll see the entire asset marked to be depreciated with no value assigned to land cost. And
Yeah.
oh, go ahead, Nelly.
Oh, I was going to say, what I'll add to that is you see this where it's correct every now and then. Sometimes condos don't actually have a land value. Some do, some don't. So if you ever don't see that, like you don't see land separated, I don't jump straight to your prior preparer was a hack, like we're going to accuse them. I would sort of ask a few more questions, see if there's a chance it's a condo, and find out, just ask about what they paid, because some preparers just back out land and don't put it on the report, which isn't great either. But don't automatically assume it's wrong. But yeah, not separating out land. We can't depreciate land, and we see this a shocking amount from professionals and self-prepared returns where people just do not make that split between the two. And before we jump forward, one other thing I didn't touch on that slide, but when it comes to doing that land separation, you have to use some kind of a fair or appropriate ratio. And there's like 6 or 7 ways that the IRS has accepted for ways you can separate out land and building, but it has to be something that makes sense, right? We can't just say, oh, I just always use 10%, or like, I just shake my magic 8-ball and let it choose for me. So the most common thing people do is look at the county assessor. So check out that county website, get really familiar with it, and see what ratio they use. So check that out, look at the ratio of like land versus building values they allocate, and use that same ratio on your client's purchase. It has to be something defendable and something that like makes sense. And this is going to vary if you work locally and in person, you pretty much will often see a really similar ratio if you're all in one county. If you're working with clients all over the place, like it can be super wild. I have clients in the Midwest who have 92% to 93% building value on their purchases. And then I have clients in Seattle who have over 80% land value because higher cost of living places. So just be really mindful of this, that using a standard split across the country, no matter where it is, doesn't work. So you've got to find an actual split to separate out that land cost from your client's purchase. So a big thing to spot, and a good kind of value to offer your clients is being the person who spotted this and who can fix it for them and get this set up correctly.
Another thing that we typically see is when we're doing our clients who are flippers, a lot of times prior accountants, just kind of see the financials and, they look at, hey, they've put this together, they have a profit and loss, and they take all of the expenses for the year, and they'll drop them in, on the year that they're working on the rehab. So we'll end up seeing, a huge expense and a giant loss on their P&L for the year because they're in the process of rehabbing a home to sell. And so, one of the things that we need to make sure of is, those properties are inventory and they're not expense, as that expense is taken. It's all, creating an inventory asset so that when they do sell, that is when we put that into the cost of goods sold. So we see that a lot on prior year returns, and unfortunately, that becomes a very hard conversation to have when somebody has a large loss on the prior year. And now we've got to go back and amend and correct that since they sold the house in the current year.
Yeah, absolutely. And this is something you'll see a lot with bookkeepers too. So not only as finding this as sort of a tax error, but a lot of bookkeepers, people in general, I think, struggle with this concept of flipping not being typically capital gains, and that the costs associated with it are going to be a cost of goods sold, and everything's going to be capitalized until it's sold. And what I tell people is kind of the way to think about this is look at it as your clients with any other business. Like to the IRS, this is the same as if your client bought a bunch of flour and eggs and sugar and all of these things and then made a cake to resell. Like this is the exact same thing. This is the same way the IRS looks at it. If they bought, a crappy house and then put in new appliances, updated it, fixed it up, and then resell, same kind of business. So you have to just treat things the same way and put all those costs on the balance sheet for carrying, and not get caught up in sort of this idea that because it's a house, something is different about it. It's still just an ordinary business with a good you're selling, and those are just the costs of producing it. I'll start on this one. So this is something that's like a personal vendetta of mine, which is like the flip side to the first thing, which is where you see no land separated, nothing separated out, over depreciating. The flip side is when like nothing is being depreciated, or where they're setting things up all in one big chunk of depreciation. So what I mean is like where you see a client, if you look at their prior year return for a rental property, and this was a brand new property the year before, and on Schedule E, you see a repair cost of like $125,000. They owned it for 2 months, $125,000 worth of repairs. Like probably not. Any big renovations typically should be on that depreciation schedule. So if you're talking to someone and they say, oh yeah, when we bought this house, we put a ton of money into it to get it rent ready, or we did a big remodel, and you don't see that on there, now you kind of have to go back and look and see if it was just written off incorrectly or if it was missed. And then the other thing we'll see is these big chunks of depreciation where things could be split up farther. And this is sort of doing your client a disservice. And we see this a lot, and it's not necessarily wrong, but what you'll see, for example, is like that same case when you have $120,000 renovation just listed as a single line item, right? $120,000, 27.5 years, boom, the end. Well, there's probably stuff in there that has a shorter life, right? Probably that renovation had some land improvements that are 15 years, appliances that are 5 years, flooring. So there's probably big pieces of that can be broken out and then potentially qualify for bonus depreciation. So really take a little more time to find these things on your clients' prior returns and kind of dig into this a little bit, because this is the feedback I get from clients where they're like, oh, my prior accountant never mentioned that, or like, I didn't know I could do that. Or so it just kind of makes you, puts you in a really good position with them. You get to be the person who sort of found them this extra savings, and it typically doesn't take much longer. And once your clients know that that's what you want, is this breakout of specific repair items, I typically have no problem getting them to sort of organize it that way for me going forward, because it saved them money. Like anytime they get money from something, like they're more inclined to do it for you. So once you can show that and prove it early on, it's a pretty good system going forward.
And then the fourth mistake that we typically see is when we don't see a prior refinance on there. And so one of the things that we typically look for when we're looking at the 1098 for the prior year is that mortgage origination date. So if we're doing the current year return and we happen to see that, hey, there was a refinance in the prior year, well, now we've got additional questions, especially if that interest jumped from the prior year. So we can kind of start to ask, hey, what was this refinance used for, and start to apply, interest tracing rules. Box 3, is I think kind of an overlooked piece of information for a lot of real estate tax professionals, because it's a way to ask additional questions, because we might be looking at, hey, there was another property purchased from a cash out refi, or maybe it was just to get a better rate. But it's a good chance to kind of touch base with our clients and ask additional questions, and see what they're doing and what they're doing with that refinance and new mortgage.
And the other thing I'll add to that I see overlooked quite a bit is on a rental property, those loan fees can be amortized over the life of the loan. So when you're talking to someone and they've owned a property for 20 years and they still have a mortgage on it, or like they've owned it for 30 plus years and there's still a mortgage, well, at some point they took out more mortgage. So like at some point there's loan fees. So kind of catching those and not missing this, because on client sides, what I think they're thinking is like, especially if it's not a cash out refinance, right? Like if they just got a better rate, especially the last few years where it was cheaper to buy a car or buy a house than to buy a car, pretty much. People were refinancing like crazy just to get into those lower mortgage rates. And in their head, they're like, well, I didn't take any money out. I didn't do anything, like nothing changed. So I'm not even going to tell my accountant, but there might be deductible fees tied into that loan. So kind of looking for, like Jake said, those changes in like loan balances, checking for new 1098s, finding out where it came from, and then seeing if there are any costs that we can write off kind of associated with it. Those are all huge. What's our final mistake? This was the mystery mistake. Oh yeah, just common expenses being overlooked. This sounds so simple, but this is twofold. I'd say I see two different things. I just reviewed a return done by another really good CPA in the real estate field. So like this was someone who just wanted kind of a second set of eyes. They just wanted feedback, basically. Like, I pay this guy a lot of money. Do they know what they're doing? I looked over the return. It was great. I was like, yeah, they did a really good job. You're getting your money's worth. The only thing when I nitpicked it was that on one of the like 12 rentals, there was no insurance expense. Almost anyone with a rental is probably going to keep it insured and pay taxes on it. So these two things you should have on almost any property. So if it's not there, then I asked the client a few more questions. So like in this case, I said, there was no insurance and this was an existing property. So it's not like they had just bought it, or maybe it was paid, at closing or something. This was an existing property. And I was like, maybe it's a timing difference. Like maybe you prepaid it the year before and didn't know. And that ended up not being the case. And this was just something that was just overlooked, right? He had a bunch of properties and it was just overlooked. Like, we are not robots, we are people, and we can all make mistakes. But these two things are, like, insurance and taxes are the two biggest things that I would say, if you look at a return at the end, like whether it's a potential client's prior done return, or when you're just reviewing your own work, if you don't see either of these numbers, like, red flag. Any of these other things they may or may not have, right? Like even a mortgage, at some point a lot of people pay off their rentals. You might not always have mortgage interest, but insurance and taxes are two things that you should pretty much always have. So always look for those. And if you see them missing on a client's prior return, to me, that's always sort of the flag that I should dig a little more, see what else might have been overlooked. And then the other things I see missing often are kind of these, I call them like the sprinkle expenses. They're like not directly tied to a rental, but they're something that a lot of people spend money on and are just easy to overlook, especially if they're new at this. So these are things like a portion of cell phone use. Like if someone has a few rentals and they're using their phone to manage it, I think it's fair to take a portion of that. Books, people buy a ton of books on real estate when they're getting going in this. Meals, sort of a lot of these just not things that they would have kept track of because they were directly connected to the property. But ask your clients, what else did you spend money on? Like, was there anything else you bought that didn't relate? Because I would say the majority of returns I see don't have these kind of miscellaneous expenses, because I think the clients give us sort of the ABCD list of costs tied to the rental. And it's not wrong, but they don't know they can't deduct those other like kind of fringy things. And I think a lot of accountants just don't think to ask it, but it can really add up, especially if they own that property for years and years and years.
Yeah, and one of the other things that we typically see and try to ask about is those new investors who are just starting out and, they're buying a lot of tools, doing a lot of the work themselves. We get the question a lot, well, can we write off labor? And, of course that's, no, if it's your own labor, but maybe we're looking at, the additional, tools expense and things that we need to consider, if you're doing a lot of these rehabs and, rental property, flip or rental property rehabs and flips yourself, questions to ask on how they're, operating.
Yeah, absolutely. I think it's really easy to overlook things when someone's new, especially with real estate, because in their head they don't know what is or isn't a business yet. And then the other thing is really just to think of it like any other business. I think part of the disconnect that I saw when I worked for general CPA firms was a lot of accountants don't like, they look at rentals and businesses as kind of totally separate things. And they're not always that way, right? So I think that's how a lot of these expenses get missed, is because for a normal business owner, if someone tells you they own a, I must be hungry for cake. I was going to say a bakery again. If someone tells you they own a flower shop, you would ask about these things. You would ask about phone and internet and potentially a home office. But I think the connection doesn't always happen on rentals, and a lot gets missed. And being the person who calls out these things and kind of asks for them is really what gets you those long-term clients who are growing in the real estate field. So I think that's, I don't know if there's another slide or just yeah. So that was kind of, those are the top 5 things that we see all the time, like that we see a lot of. There's of course other common things, but we just wanted to sort of cover a handful of things that we see repeatedly from tax professionals. Hopefully it just sort of triggers some light bulbs, or, tells you, oh, I should go back and look at so-and-so's prior return. I think I did see that. I get to now email them and, point out these things we can amend and fix or do all these things for. Did anyone have any kind of specific questions tied into real estate, or anything that we can answer for you? I know there was a question in the chat earlier where someone had asked about how to figure out that local split for land and building if it's not a client close to you, where you're not familiar with it. And there is really no good easy way to do this. This is like one of the banes of my existence, and I keep trying to get one of the people in attendance here who is a tech guy to build me something to put all this information in one place, but I guess it's really hard. But I will typically just Google the county, find the county on the HUD statement, and real property lookup is a really common term that finds it, or county tax assessor or property tax assessor, any combo of those codes. And then you just have to go down a rabbit hole, because some county websites are literally a 12-year-old built them in 1985 and they haven't updated it since. So Godspeed, I wish you guys the best finding it, but that's the trail I tend to go down. Rob asked, what about travel expenses to visit a rental in another state? This is another good, often misunderstood topic, because if you already have a rental there, to the IRS, you are in business there. So as long as you're going there for a legitimate reason, right? If you own rentals in Orlando and you go there and spend 7 of the days at Disney World, and then one day you quickly drive past your house off the freeway and wave at it as you're driving, we can't write off that trip. But if you own houses in Orlando, you fly there on a Friday, you meet with your local property manager Friday evening when you get there, spend the weekend at Disney, and then on Monday you go to the houses, do inspections, meet with your tenants, spend the whole day doing property stuff. Then we can look at those things. Then now we have a business trip. If you don't own rentals somewhere yet, people get asked this a lot, I think, by clients, or at least I do. If you don't own rentals somewhere yet, can you write off that trip? No. I would just spend my life traveling the country looking at cool houses and writing it all off. So that's all startup cost. You've got to capitalize that. It'll roll into whatever you end up buying, but you can't just travel and look at houses and write it all off. Leo brought up that in the state of New Jersey, the county tax statements always show the land value significantly more than the building. Yep, just like Seattle. It's those high cost areas where there's less room to build, versus the Midwest, where you have 100 acres of cornfield and a 3,000 square foot house, and your property taxes are $7. So if you're in one of those expensive areas, the land value just tends to skew so high. Yeah, and then Brad said where he lives in Pennsylvania, which is really rural, they see the exact opposite. So this is why you can't use a standard split, because if you guys swapped clients, there would be, I'm sure it would blow your mind some of the numbers that you have. That's what we'll do next time. We're just going to do land value speed dating. Everyone's going to meet up with another tax pro, and we'll all just share the type of numbers we get in our local market and see who's the most shocked. Perfect. Did we have?
Brad, we were doing a little training, and we had, that kind of same thing. It's, in our area, the appraisers all are 17 to about 24%, depending on what county you're in. So we see a pretty tight range locally, but yeah, when we're dealing with clients, coast to coast, it varies significantly. Jim, some county assessor's office don't provide land values. So from there, what we try to do is, ask for an appraiser or appraisal. A lot of times, when that purchase happens, there's the appraisal on the front end for the bank. So a lot of times you'll have that listed in there. That's one of, kind of our best options as well to look at. That way we've got it on paper. We have, a professional who's, assigned the value, to building and land, and something we can always point back to. So I know we've got some other options as well, but those are kind of our two foolproof ones that we lean to.
Yeah, that's what we do as well. As I look at county and appraisal as kind of my starting point. But Jim, that's a really good point. Some counties do not have this. Just came up in one of the Facebook groups where someone was dealing with a client in Arizona, and some of the counties in Arizona do not have this information. They don't publish it on the county website. They don't send it to you on your tax record. They just give you an overall assessed value for your tax. They don't split it between building and land. So when that happens, it's like, well, you've got to do what you can to try to get the most reasonable match. Depending on their relationship with their agent who sold them the house, they can often say, hey, can you just pull me, are there any land comps in the area? Can you pull, if their house is on a 1/4 acre, is there any land that has recently sold within a few miles that's also a 1/4 acre? And that'll give you a good current market value for the amount of land they have. So that's kind of another option you can go with. That's sort of third on my list. And then from there, they get kind of squirrely. But yeah, sometimes it's sort of a losing battle to try to find that information. Mark says, Arizona, Pima County doesn't give you any help. That's probably what we were just talking about. You guys have scorpions and no land values. That's really unfair. All right, well let's see. Last week, weird situation. Oh, chat scrolled. Jake, they said, last week I got a weird situation with 2 brothers where they paid the down payment and B got the mortgage. Only B is on title as owner, but A gets the rental income and pays the mortgage. B is just helping out the brother. On top of that, rental was never reported on either return. That's the the fun hook of that statement. So, well, I mean, so this is one of those things. You see the weirdest stuff in real estate, and I'm always telling people this. It's the only industry, I feel like, where people are specifically told to do this for tax benefits, right? No one's ever like, you need to go be a dog groomer. There's awesome tax benefits to washing dogs all day. You never hear it, no other industries, but specifically in real estate, I talk to people who are like, I don't even care if I make money. I just got into real estate for tax benefits. And so you see a bunch of weird setups, right? You'll see stuff like this all the time where it's 2 people get together and one person's like, I have a 700 credit score. And the other person's like, I have a bunch of cash and I keep my money in a shoebox, so I don't have a credit score. And then they buy properties together with a handshake. So what I would say is in this case, there's something called constructive ownership too. So if they are, did you say, no, only one is on title, but the other put cash in, I would say they have to figure out how they're treating it. And if there was any kind of contract in place, see if there was anything legal set up related to it, right? Did they do anything to figure out who was going to report this? And there just has to be an agreement. They just can't double dip. So I would say typically the person on title is who should report it. But there just has to be an agreement that they're not both picking up the income or both picking up the interest or something like that. Brad said, Arizona might have scorpions, but it's also 20 degrees warmer. Well, that's fair. Jake, you want to look at the next question?
Sure. So Shalita says, if the client refinances their primary resident and uses some of those funds to renovate an investment rental property, how should you trace that interest for proper classification, personal versus business? So, that kind of goes back to our slide on that refinance and the interest tracing rules. And we were kind of talking about, the detailing questions that you need to ask there. So a lot of times, it's kind of a year over year tracking for us is to make sure that we know, when that refinance comes out and where that interest is going and where it's attributed to. So it kind of traces from, that personal to the rental property. So do you guys do anything different other than that?
Yeah, so I think the biggest things is this changed a few years ago, and I think a lot of people don't realize that. Is so now like home equity line interest is really limited unless it's because this comes up a lot in the Facebook groups where someone's like, my client took out a home equity line, but I think they can only use it to improve or renovate their personal home. And that is what it says in regard to it being treated as personal interest. But interest tracing lets you trace interest based on where it's used. So think of loans as the being deductible based on where its proceeds were spent, not the asset securing it. So if someone takes out or refinances their personal home and then uses it for a business use, you can typically deduct it there. You want to do this as clean as possible, and there's kind of some more rules around it regarding the timelines. You really want it to be, I think it's a 30-day on either side for some of the spending, because you'll run into this sometimes too where someone's kind of reimbursing themselves if they bought a property cash and then paid themselves back with a loan. But yeah, you need to trace that interest, and so you want to have them do this as cleanly as possible. We just recommend clients put it into a clean bank account, because you need to be able to show that that HELOC money is what then was actually used to like buy or fix the rental, not like, oh, I took out 10,000, I threw it into my account with my existing 20,000 of savings where I also buy my like Amazon Prime subscription and order pizza from and everything else, and then I bought a rental. Like put it in and just create a new free bank account to keep things clean. Is there a spreadsheet for that? Maybe a shared Google Sheet with the client. I mean, that's a good idea. I keep spreadsheets, I know, for clients for their loan and tracking it year to year, because there are some clients where it's all they do. It is all they do is basically buy and refinance. And so there's just a constant churning of loans, and trying to keep track of this becomes really tricky. And especially because a lot of accountants don't. And so it's the correct way to do it. And then they come to you and you're like, hey, we need to. And they're like, well, but why? This is so much more work. But there's good and bad. It makes some loans that we're told weren't going to be deductible, and vice versa. But you have to just trace the interest according to where it goes. And that's what we do here, is kind of keep a spreadsheet for each specific client. Did we have any other questions or anything else I can run through, or Jay can run through for you guys? Does anyone have any real estate questions? You want the deduction, got to do the work. Actually, absolutely. Yep. Awesome. Yeah, so I'm excited everyone came and hung out with us. I hope this helped provide some information. We just want to kind of put something together quickly to welcome everyone to the group and share a little bit of info, add a little value. Probably do something more in the future. What do we have?
Yeah, and Eric, and we're glad you're here, Eric, because this is something that we're all passionate about and really enjoy, and so something that not only a great place to learn, but also bounce ideas off and put different things out there. So welcome, and we really are glad that you're all here.
Yep, and I think a lot of us, like almost everyone I know who started or who is now like real estate specialized, started in a general firm. I don't know anyone who was real estate from the jump. Like I wasn't, but I remember there being this point for me. So I'm a big fan of being specialized in tax, and I know it's not for everyone. Some people like the diversity and things like that, but I want to be really, really good at one thing. And so I just found my little bubble and I live in here. But I remember when I was working for a CPA firm and having a client who had a petting zoo. And I remember as I was researching how to depreciate a zebra, just sitting there being like, when am I ever going to use this information again? And that's always what I think about. I think of people who are like doing a little bit of everything. It's like, you're going to have to research the zebra like over and over for different things. So for me, being specialized is like my jam, but that's why it's great to have a group like this or just have someone like you don't have to be an expert at everything. You just have to know someone who is. And that's kind of how I operate. Like there's so many tax industries, what I was saying earlier, where like I don't touch them, I don't really specialize in it, I don't know it, but I probably know someone who does. So that's all it comes down to is like knowing when it's time to refer to someone else and finding someone else who's the expert. Awesome. Well, if there's not any other questions, I think we wrapped up a little early today. I talk really fast and I'm sorry, but like I said, we'll probably do this again and hopefully have better topics and more info for you guys. Bring your questions to the group and we'll throw together another event and hopefully we can keep doing these and make it through tax season. Hopefully, knock on wood, everyone. There's nothing crazy that comes up, but I appreciate everyone joining us today. And if you're not in the Facebook group, come find us and invite your friends and happy investing.
Thanks, everyone.
Bye. Thanks, everyone.